Should you do a LIRP if you are in or near retirement and you have a pension and you have $1 million or more saved? That's what we're going to cover in this video. My short answer is obviously it depends, but I want to tell you, a lot of times when people talk about the LIRP, they're talking about tax-free income in retirement. Well, we're going to break down in today's video why that may not make the most sense for most people and why we typically don't recommend a permanent life insurance policy to get tax-free income in retirement, especially for those who are maybe late 50s, early 60s. We're going to break down all the reasons why, but we are also going to break down where life insurance could make sense in your plan at this point in your retirement, because obviously you probably don't have a need for life insurance at this point as far as survivorship to make sure that your family's taken care of. Your debts are probably paid off. You're probably self-insured with your $1 million plus. You may or may not have taken a survivorship, which we'll break that down as well. But those are all things to consider as you make this decision. So this actually came to us from one of our clients who said that there's an advisor that was talking about, in town about this LIRP and how they made it sound really good and they needed to do it. And, we basically told them, you don't need to do that. So that's what we're going to talk about on today's episode of Joe Knows Retirement.
Joe knows taxes.
Joe knows the market.
Joe knows Social Security.
Joe knows income planning.
Joe knows pickleball? No.
This is Joe Knows Retirement.
So my name is Joe Schmitz. I'm the CEO and founder of Peak Retirement Planning. We're based in Columbus, Ohio, but we serve clients all across the country with pensions and between $1 to $10 million saved who have been that Midwestern millionaire, hardworking, frugal, diligent saver. And this is what that channel is for. It's to educate those, that crowd. We call it the 2% club because there's less than 10% of people with over $1 million, less than 20% of people who have a pension. You combine those two percentages, we're left with around 2% of people in the population that really fit the niche of this pension channel that we talk about here. So if this is speaking your language, go ahead and subscribe to this channel, like our videos, and that will be able to reach more people. Feel free to share our video with others. We've gone from 0 subscribers to over 50,000 subscribers in pretty much less than a year and a half. And so this channel has grown like crazy. We've gotten a lot of people to reach out to us wanting to work with us from this channel. And we do always welcome that if you've been watching this channel for a while. So let's break this down here. And let's first start off why we don't believe that a LIRP makes sense for most people for tax-free income in retirement. Now, I do have to disclose in the video I do today that this is general advice. This is not specific advice. We don't know your specific situation. We have a pretty good idea of your situation if you have a pension and $1 million or more. So that's the generality that I'm talking about here. I'm not talking to a 30-year-old on what to do with this life insurance decision. I'm talking to someone with a pension $1 million plus in or near retirement. So at least you have to know that as you take that in. Now, I do want to break it down for my personal situation. This is something I've personally looked into for me. Now, like I said, I'm in a different situation than obviously people who are watching this channel. I have a high income. I have a business. I do not plan to retire here soon. The cost of insurance is a little lesser for me than someone in their 50s and 60s. So this strategy could make sense for someone like me more so than someone who is older. But I'll even tell you, for personal preference for me, I've actually decided not to do this strategy in my plan. Now, that could change as time goes on, but I just want to be overly transparent with you. And as I always say, if I would not recommend something for my parents, I would not recommend something for our clients. And this is a case where it's even better for me than it is for most of our clients, and I still don't personally recommend this for me to do personally. So just keep that in mind as well. When these advisors are really pushing this stuff, when I've ran the numbers and I've done the math, I just don't personally think it makes as much sense for my financial plan versus other opportunities I could use with my money. I max out my Roth 401k every year. I max out my Roth IRA. I do a backdoor Roth IRA every year. And so I am only left with non-qualified investments or a life insurance policy to get tax-free income are two options that I could have. Now, I personally invest in some real estate as well, but if with those two options, I prefer the non-qualified because I put money into there. I tax loss harvest. I take advantage of the losses so that I can write those off as income up to $3,000 per year, and I can carry that forward for years to come. And I try to drive my basis really low in those accounts. And then when I get a very high appreciation every year, I take those out. I transfer those to a donation donor advised fund, and then I sell those off of the donor advised fund. I don't have to pay any capital gains. All of that appreciation is tax-free. Plus, through the tax loss harvesting, I was able to get some losses that I was able to offset other gains or use towards income like I talked about. And so in that case, that could almost be a tax-free strategy in itself, for someone who's charitable. So as you can see, this is going to be dependent on the situation. So let's break this down more specifically for you. But what I want you to do while you're watching this video as well is make sure you put in the comments, do you disagree or agree with me? I'd love to have conversations. We always try with the comments to always comment back with our perspective, answer any questions in there. So I'd be glad to share your perspective. You think, Joe, hey, you're spot on, or hey, Joe, I think you're missing this. Let's have some fun with that to make sure that we can explore this further so people have different perspectives than just mine from the videos that they're watching here. So one of the big reasons why I don't believe this is a great use for tax-free income is because of the high costs associated with these life insurance policies. Again, the cost of insurance goes up the older you are. So if you're in your 50s or 60s, you're going to see a lot of the premiums you're putting into this go towards the cost of insurance, because if you pass away, you're more likely to do it sooner rather than later. So the insurance company has to make even. They have actuaries here. They're running all the numbers. Insurance companies are going to make their money with doing something like this, not losing money, knowing that they've got millions of people to pull from to make sure that they're making the right decisions on this. And so if you were to invest your money in the S&P 500 or the VTI, Vanguard Total Stock Index, or any index funds out there, your costs are very, very, very minimal. Or if you invest in an individual stock, you have no cost. Versus here, you're going to have more added cost associated with it. And if you are looking for that type of protection that maybe a whole life policy could provide you, or maybe an index universal life policy could provide you, there may be better options for that. There may not be tax-free income associated with it, but a little more growth opportunity while still maybe getting some protection that you may be looking for from other insurance products out there on the environment. So it all comes down to, what are your goal? What are you trying to achieve? And that goes hand in hand with the second point here, is that the cash value growth is not going to be as effective as, maybe growing it in the market or growing it in other opportunities we talked about. I mean, this cost of insurance is going to be higher up front. And so if you're 60 years old, you have to ask yourself, how long is it going to take for this cash value to accumulate to my favor? And most of the time it takes 10 to 15 years for these cash value life insurance policies to really be able to break even and even do better. It could be sooner depending on the index performance or the performance that whatever that insurance company is tracking there to decide what that cash value growth will look like. But in order to have that growth, when are you going to be planning to use this policy? And then that goes hand in hand as well with the third point that I want to talk about, and that's the higher surrender cost early in the policy. And that's why it's going to take 10 to 15 years to really see some benefit from this policy, because if you were to surrender this policy 3 years in, you lost money on this deal likely because of that high surrender cost. And that's also what's going to cause this to be a slower growth as time goes on. And so if you're planning on taking income in 5 years or 10 years, that withdrawal is not going to allow your cash value to grow as much, because you're going to be taking a larger amount out because of that penalty associated with that. The fourth thing to even consider is this even an option you can take advantage of, right? It all depends on your health. And so a lot of times, insurance companies will either go standard rating or preferred plus, which is the highest rating you can get, or maybe they'll rate you up and give you a higher cost of insurance and a higher premium for the amount of insurance that you're getting there. And another consideration, if you are just going to go do this and not listen to me, something you may want to consider when you do this policy is, if you are looking for extreme cash value growth, typically you want your death benefit to be as low as possible. That will allow your cost of insurance to be lesser. And then you want your premium to be as high as possible as well. And there's a lot of advanced ways to structure these life insurance policies. So it's always important to work with an expert, not just an insurance salesperson, that understands how this works within your plan. If you really want to do this plan, make sure you're being very diligent there. But I can tell you personally, with our clients, we have never done this type of policy before, because we just don't feel like it makes sense for the crowd that we serve. Now, that doesn't mean that we wouldn't recommend this something in the future, because whenever you think of financial planning, you always want to be extremely open-minded, because anything can happen at any time. And so we never want to say no forever. We're always open to options and opportunities out there. But it all comes down to, at the end of the day, what is going to make the most sense for the client in their particular situation at that time to make the decision. And the fifth reason why we typically don't recommend this for tax-free income is, if you're not maxing out your other retirement accounts, such as a Roth 401k if you're still working, or a Roth IRA if you're able to contribute to that if you're still working, then those are going to be the maybe better better options for tax-free income for some people. All right, there's many things to think about, but remember, with an IRA or a 401k, if you're really attracted to the index options, the whole life protection that we talked about earlier, then you can look at more conservative options with these vehicles while not having the cost of insurance or the surrender charges or some of the complexity that comes along with it. So just understand of what is the order of operations of your saving and what makes the most sense for you. And that leads me to the sixth key point to understand when looking at this opportunity is the complexity. And as we've already talked about today, you're probably getting a little lost with some of the terms and lingo and structuring of this type of policy. And it can be very advanced. And we've broken down a lot of these policies with our clients who may have already had them before they came and worked with us. And we've been able to restructure them or reposition them or change the amount we're putting towards it or lower or increase the death benefit. So there is a lot of changes if you already have this type of policy that you can make to make it more advantageous for you. But just make sure you're working with a team that really understands how this works. So that's me bashing the tax-free income side of this. Now, let me suggest where we'd actually look to use this for other opportunities. So like I mentioned earlier, we don't use this for tax-free income for the majority of our clients. What we typically look to use life insurance for, if we were to use it, and it's a very small portion of our clients that actually do life insurance, but a lot of times we'll use it for many opportunities. One could be for tax-free legacy. So maybe they like the idea of if they pass away, they want to leave some to their loved ones, tax-free, guaranteed amount, and that can be something attractive. Now, if they're going to do that, the way they're going to structure the policy is going to be different likely than what we're talking about with tax-free income. They probably want to structure the policy to have the maximum death benefit. We probably want to have a guaranteed death benefit. So if they pass away, they're always going to have that in place. Typically, we look at a guaranteed death benefit up to age 100 or 105 or 120, whatever makes the most sense with clients. But obviously, the higher you go to guarantee it, the lower the death benefit may be or more the premium may be. So just understanding how that can work, what's your longevity expected to be, and then making a decision from there. But you want to do that. And obviously, if you have a guaranteed death benefit, just make sure you're aware that this is probably something you want to keep for the lifetime of your life, because if not, it's going to be higher insurance costs like we talked about earlier. It's going to be, higher surrender charges like we talked about earlier. But if you plan to keep this in a long place, none of that really matters because you're not using this for cash value growth like we were over here. You're just using this to say how much is a maximum death benefit I can do. So maybe you want to put $10,000 into this every year. Maybe you want to do that for 10 years. You say, I want to put $100,000 into this. Well, that may be able to get you a guaranteed $200,000, $300,000 depending on your insurability, depending on your age, depending on all those factors. And that could be something where, hey, we took care of our legacy goal. Now we can go spend the rest, right? And so those are all considerations to consider there. And another reason where we use life insurance is, again, most of our clients are self-insured. They may not need life insurance at this point. But for those who may not want to take the survivor option on their pension, and maybe instead of using that $500 or $1,000 difference that it would be if they left, that pension to their spouse, maybe a more useful of that money, if it's needed for the family to be successful, is put that towards a life insurance policy. And maybe you have a combination of some term policies to have the cost lower to cover you for the next 10 years and maybe 20 years. And then you have a permanent policy that goes for your entire lifetime. So maybe you live another 25, 30 years. Well, with your pension option, if you die and then your spouse only lives 3 more years longer, that only pays out for 3 years, but you got to pay for it for 30 years potentially. And so that's where a life insurance policy can really make sense for those people in those situations. But it is important to look and see, maybe you don't even need to take the survivorship option or do life insurance and still be fine. Again, you always want to run the numbers, but if you have $1 million or more saved and you've done a great job of being a diligent saver, you may be able to self-insure at that time. Now, we would never recommend someone do that unless they fully run their numbers and have an analysis that shows that if they passed away tomorrow, everything would look fine and good, and that spouse would not have to worry about money or not have to take any, pay cuts or whatever it may be in their standard of living to make sure they can enjoy and not stress moving forward. Another benefit of using life insurance is for the tax-free benefits for long-term care. And so this is something that not all policies have. So if you have an older policy, this may not make sense. But if you do, maybe look at looking at getting that replaced or looking at getting that graded or refinanced to look at a better opportunity there. And so with this, if you need to accelerate the death benefit for long-term care anytime in retirement, this is something that you could look at doing and have that be used for tax-free. And so it can be a great way to have another bucket of money to get that, so you don't have to worry about taking out money from a down market or worrying about taking out money from your retirement accounts that could cause a taxable event. So this is something that could be a good band-aid to help you cover some of the long-term care coverage that you may need moving forward. And this type of strategy could make sense for those who maybe have a larger amount in non-qualified type investments. Instead of having to worry about all the capital gains as time goes on there, this is a way that you could take some of that, and then technically all the money that you put in this policy, when you pass away, all of the gain, right? If you put in $100,000 and it's $300,000 when you pass, all of that gain is technically tax-free. So not only is the death benefit tax-free, but all the growth during that time, you don't have to worry about any gains from your investments on your tax return. It's basically deferred tax, and then it's tax-free when you pass away. And so some people like that concept, and some people like diversifying their asset mix for their legacy. I mean, there's no one to say that investments will continue to go up 7 to 12% each year forever. I mean, I personally believe they will, and if they don't, then I think we're going to be facing bigger problems. But that's where a life insurance policy, maybe the long-term return, the ROI, the after tax, when you consider the tax benefits, maybe it's a 5 to 7% return for most people. It's a moderate growth, but it's also a guaranteed death benefit, which you could argue could make sense if that's the rate of return. That can be pretty attractive for some people to use it for that legacy rate of return. Now, that's likely not going to be the rate of return if you're looking for tax-free income, obviously, but that could be the rate of return based on the guaranteed death benefit. And so we run some illustrations for clients to see if that makes sense and see if that's something that's attractive to them to have that type of rate of return, or maybe they want to seek more growth. And if so, then maybe that's not a great option for someone who's a little more conservative. So it's just a way that maybe when they pass away, all the investments are down. Well, the tax-free death benefit of life insurance is going to be available right away. Maybe they look to use that early on in the retirement, especially if the spouse passes away. The other spouse has that there as an extra cushion, or to pay off any debts or whatever it may be. Or for your kids, maybe that could be a great benefit for your kids, and then they can write out the investments as time goes on. And another point I want to talk about with the life insurance, this is something that not everyone has to be worried of, especially with the clients we work with. Most of our clients are 1 to 10 million saved. Their net worths are right around that amount. Some have a little higher net worth when you count their other type of assets, real estate, and other things that they may have. And maybe when you're 60, your wealth is going to maybe double or triple by the time you pass away. And so something that people use life insurance for is to put it in what's called an ILIT. And an ILIT is an irrevocable life insurance trust, which allows you to avoid estate taxes with this type of vehicle. And so there's a lot that goes into this conversation. This only applies right now, especially due to the One Big Beautiful Bill you pass, for those who are $15 million in net worth if they're single, or $30 million if they're married filing jointly. So that doesn't apply to many people who watch these channels, but for many of these Midwestern millionaires, that could be a reality over time, especially as they look to potentially lower those limits. So we know it's permanent right now, but permanent until it changes. And so that's something we're really paying attention to, because that estate tax could be 40% on that money. So let's say you had a life insurance outside of an ILIT. If you had $1 million and that all went to your kids and you were over the estate tax limit, $400,000 of that could go to the government, and then your kids only get $600,000. If you put this in an ILIT, then all $1 million could go to the kids, and you don't have to worry about that going to the government. So those are some of the advantages of doing that, but you also want to look at some of the downsides of that too. Obviously, it's an ILIT irrevocable, meaning you can't get access to that. That's typically not a problem with most people setting up this type of life insurance, because if you're doing a guaranteed death benefit, like we talked about, you're probably not looking at taking from the cash value. So hopefully this is an educational video for you to be aware of what we call LIRPs, life insurance retirement plans. You've probably seen them before. Maybe when you're at a steak dinner in town and one of the advisors was showing you all the advantages and index credits, and you make money when the market's down and gain more on the way back, and all those types of sales tactics that people use to get the big commission on this type of product. So just be very aware, know the pros and cons in anything that you look at with your retirement plan, and I hope this can be a useful place for you. And so, like I mentioned earlier, now that you've watched the video, go in the comments, leave me some thoughts. Did you agree? Did you disagree? What did I miss? What do you have questions on? What can we do to help you have a better retirement moving forward? This is Joe Knows Retirement, and we'll catch you on the next video.